Welcome to a podcast produced by the Edison Group. The market is often much less knowledgeable about the company's equity story than its management team might expect. Edison fixes that knowledge gap with one elegant solution, Investor Relations 3.0. Using an integrated program of research, marketing, and direct investor engagement, we accelerate, widen, and magnify the market's interest in a company's investment case. I'm Milosz Papst, and I'm a Director of Investment Trust Research at the Edison Group. Together with Richard Williamson, who's Director in our TMT team, we are covering HgCapital Trust, a specialist private equity investment company focusing on software and services businesses. We have recently published a new review note where we explore the company as an attractive alternative or complement to the big tech exposure offered by most popular listed tech-focused trusts and major global tech ETFs. In this podcast, we would like to go over the key takeaways from the research report. Richard, you have come up with the title of our research note, which is The King of Dulltech. I like it even more than what I have come up with. This dull is beautiful, but I feel that both headlines accurately capture the essence of HgCapital Trust, or HGT. Can you explain to our listeners what you meant by it?
Yes, certainly. On the face of it, I suppose we're being rather unfair to our client. However, it does concisely convey a clear message to investors. Firstly, HG does not invest in anything glamorous or well-known. There are no consumer brands in its portfolio. It invests in B2B companies, typically in the financial services software space. Businesses that often provide important services to a wide range of SME customers that provide payroll, accounting, HR, and other business critical functions. Secondly, HG's investment strategy is not likely to change significantly anytime in the near future. HG has an established process working in its established sectors. So tax and accounting, ERP and payroll, legal and compliance, automation and engineering, insurance, tech services, wealth management IT, and healthcare IT. This list certainly does not get my pulse racing. However, the sorts of companies that HG has invested in have delivered market-leading returns over 5, 10, and 20 years. 24%, 18%, and 16% for the record. And so we expect HG to continue to tread this path over the next 10 years or more. The SaaS theme and digitalization of everything have much further to run, and HG is happily, or perhaps dully, riding this wave. This is tech, but not always very exciting tech, and HG owns the sector in Europe, delivering consistent returns to investors. Milosz, tech has become one of the most sought-after sectors in recent years, but why should anyone prefer a listed private equity company over an investment fund focused on listed tech companies?
Yes, I understand that investors may be cautious at first, given that private equity is considered an alternative and lesser known asset class. However, I believe that the private equity sector has evolved over the last 15 years or so, and should be now an inherent part of each investor's asset allocation strategy. And there are a number of reasons for this. Firstly, companies tend to stay private longer, which means that private equity investors capture a greater share of the value accretion of these businesses as they develop. This has been facilitated by the growth in capital available in the private equity space, allowing to fund larger private businesses. At the same time, the number of public companies has not been increasing over the years. Secondly, private equity managers now focus more on active ownership than plain financial engineering to generate returns, which is also illustrated by the increasing specialization of PE managers. HgCapital Trust investment managers is a very good example. Strong expertise in selected software and services subsectors, an extensive in-house value creation team with well-tested solutions to bring a private company to the next development level, facilitating knowledge sharing among management boards of portfolio companies, and so on. This provides incremental value compared to investment funds focused on listed tech companies. Richard, now the question which comes to my mind is, to what extent is the market for the business-to-business, so B2B services offered by HgCapital Trust portfolio companies already saturated? Would a new investor in HgCapital Trust be late to the game? What do you think?
I think, as I mentioned earlier, the SaaS theme and digitalization of everything have much further to run. Recent stats I've seen suggested that by the end of 2021, 99% of companies were using one or more SaaS solutions. and approximately 78% of SMEs have already invested in SaaS options. However, even where companies have adopted one or more SaaS solutions, there are many more pieces of software that they otherwise have to buy or license up front that could alternatively be delivered via the cloud, allowing them to be paid for as they are used and kept constantly updated. As comfort these trends have many years to run, I'd point out that the US SaaS market is at least 5 years ahead of Europe and is not slowing. And at the recent Capital Markets Day, HG indicated they thought that trends would run for at least another 10 to 20 years. So investors should rest easy that there is still plenty of runway left and significant value still to be created. Milosz, you've talked a lot about the value add a private equity manager can offer. Has this been reflected in HgCapital Trust performance compared to investment companies and ETFs focused on listed tech stocks?
Well, yes, that's a good question. HgCapital Trust sector expertise has allowed it to consistently deliver strong performance, and it has generated an NAV total return of 17.6% per annum over the last 10 years, which is materially above the broad listed UK equities market, as illustrated, for instance, by the FTSE All-Share Index, which delivered only 7.2% per annum over this period. This has also made HgCapital Trust a top performer among UK-listed private equity companies. Now, when we compare this to major UK-listed investment companies focused on public tech equities, as well as major tech-focused ETFs, we can see that HgCapital Trust performance was somewhat behind these two groups over the last 10 years. For instance, it returned around 400% compared to an average 490% for major UK-listed tech-focused investment companies. However, I believe that this was at least partly due to the particularly strong returns of big tech companies such as Facebook, Amazon, Apple, Google, Netflix, and so on. This stellar performance may be difficult to sustain over the next decade, while the performance of the, as we call it, Dulltech companies HgCapital Trust usually invests in seems much more repeatable. This is already illustrated by the fact that HGT outperformed both peer groups over the last 5 years with its NAV total return of close to 200%. This has been underpinned by HGT's solid internal rates of return in excess of 30% on its investments. Now, Richard, we both know that quality comes at a certain price, and that good tech companies have enjoyed high valuations. Is it still the case?
Yes, you're certainly not giving me the easy questions, are you? This is a fast-moving market, so what I say today may not be true tomorrow, but I'll do my best to answer. As we all know, valuations in the technology sector in particular have been under intense pressure over the last 6 to 12 months. Generally speaking, I would say that technology valuations have fallen between 30 to 50% from their peaks. And this is borne out by the BVP NASDAQ Emerging Cloud Index, an index of US SaaS businesses. And this has fallen by 27% over the last 3 months and 42% over 6 months. The companies still trade at 8 times revenues, with revenues growing at 38% on average. The size of these falls reflects high technology multiples, rising inflationary expectations, and as technology company profits are often a long way into the future and growing fast, valuations of cash flows discounted to today, DCF valuations, are very sensitive to rising inflation. There are also the numerous other geopolitical factors that I won't rehearse that have made investors nervous and flee to quality. So when I last looked at HGT, it was trading at about 0.9 times NAV versus a direct technology investor peer group at around 0.7 times NAV. Similar to the tech stocks, the share price of the listed technology investors have also dropped by up to 50%, widening the average discount to NAV. So HGT trades at a premium to its direct peers, but still trades at a 10% plus discount to its most recent quarterly NAV of 433p per share. So yeah, in sort of conclusion, I suppose HG offers quality at a price. Valuations are coming down, but HG's portfolio of proven late-stage technology companies is well placed to resist softening valuations. Right, final question for you, Milosz. How about HgCapital Trust's current valuation? Is it an attractive entry price?
Thanks, Richard. You already touched upon it. Obviously, we do not issue buy or sell ratings at Edison, so I will not give you a definitive answer. However, what I can do is outline the key valuation factors an investor should look at when considering an investment in HgCapital Trust. As you have pointed out, public tech valuations, which are a reference point for valuing HGT's private equity investments, have softened a bit from the demanding levels we've seen last year. HGT's last reported net asset value partly reflects this, as it is based on end March 2020 valuations, and the company's shares now trade at a low double-digit discount to this NAV, while in recent years it normally traded close to NAV. Still, it is difficult to conclude whether public markets are bottoming out or we will see a continuation of the public market downturn with investor concerns of an economic recession, inflation, as you've mentioned, which could exert further pressure on private equity valuations. As at the end of March 2020, HGT's top 20 investments were valued at an enterprise value to last 12 months EBITDA of close to 27 times, which may seem high in absolute terms. However, this is at least partially underpinned by a number of factors. HGT's portfolio companies have exhibited high sales and earnings growth, as well as strong cash flow generation in the past. HGT deploys a buy and build strategy, and successful serial buyers normally command a certain valuation premium in the market. I would also flag the defensive profile of its portfolio companies, which, as you already discussed, are providing mission-critical, low-spend services through a recurring software as a service subscription model and indirect sales channels. And finally, for the 57 realized investments over the past 10 years, HGT posted an average valuation uplift compared to previous year-end valuation of 30%, suggesting a conservative valuation approach. Finally, if we consider HGT as a tech conglomerate and try to calculate the average EV/EBITDA for HGT as a whole, that is covering both the fund level and its portfolio, it turns out that HGT trades broadly in line with major listed European software companies. Thank you, Richard, and thank you all for listening. Please read our full research report at www.edisongroup.com.